But 99.9% of the tax law is really a directive on how to reduce your taxes, how to pay less tax. Absolutely believe best investment you'll ever make is in your CPA. And if you put a tax on investors, in other words, you're putting the money, you're taxing the people who invest, you're going to put a drag on investment.
Tom, thank you for coming on the show today. It's like we were talking earlier. I'm always hesitant when I get somebody who wants to talk wealth, taxes. My head starts spinning. I thought, how are you going to make this interesting enough? And, I've watched a good number of videos on over the last week of everything you've done, and you seem to kind of wrap that around your finger and able to present it very well and simplify it enough for all of us to completely understand. So thank you very much.
Well, I appreciate that. My stated mission in life is to make taxes fun, easy, and understandable. Because and people always laugh at the beginning. By the end, they're having fun. But the reality is, you look at fun is a major part of taxes. Just look at the word refund. It's right in the middle. So everybody has fun with a refund. Nothing wrong with that. So as long as taxes are a positive aspect of your life and not a negative aspect, they can be a lot of fun.
Yeah, I think, because you've got that attitude, it really helps. And I think you're going to be able to really shed some light. I think there's a lot of opportunities here for you to educate some of our viewers. But let me give a quick background on you, Tom. Tom's a CPA, podcaster, and author. He has Tax-Free Wealth that's out, How to Build Massive Wealth by Permanently Lowering Your Taxes. That's a long title. Tom was a CPA at Ernst & Young. He is a CPA for Robert Kiyosaki. He has started multiple companies that specialize in wealth and tax strategy. You must have been just a nerd growing up.
You would think that, but as it turns out, I'm actually nerdy in some ways and not in others. I'm kind of an anti-accountant. I actually like people. That's why I do what I do, because I like to help people, and I like to make taxes simple so that it's a big part of our lives, whether we like it or not. And so, if Einstein reportedly said that the most difficult thing in the world to understand is income tax. I'm going, if I can take something that Einstein thought was complex and make it simple so the average person can understand it, I'm going, that's a big win.
Well, and you've done that. Let me finish your intro here. Tom is also a leading expert and published author on partnerships and corporate tax strategies, a well-known platform speaker, and a wealth education innovator. Today, we want to change the way you look at taxes and where the opportunities lie. You have just, from every CPA I talk to, you have a completely different outlook on it. Can you what exactly do you mean by tax-free wealth? What are your thoughts on it? What do you think it means?
Well, I actually think you can actually get to a tax-free wealth. I have clients who are living tax-free and legally living tax-free. Yeah. I think the most important thing, the very first thing to understand, is that the tax law is fundamentally a series of incentives.
Right.
And it's basically a roadmap to reducing your taxes and building wealth. And everybody, I think the very first time we get a paycheck as a teenager, we look at the pay stub and we go, how come my pay is not as much as I thought it was going to be? Who the heck is this FICA person?
Yeah.
And we realize that we're partners with the government, and we don't get to choose that. What we do get to choose is, are we a good partner? Are we a silent partner? Are we an active partner? How much do we pay attention to it? We're not talking about loopholes and things to get around. We're talking about, here's what the government would like us to do. And if we do what they want us to do, we pay less tax.
Right. It's something, I was watching a video and you said the tax, it's more of a roadmap. And I thought, okay, that was kind of the kicker for me. It's like, okay, you come in a different angle, but you're exactly right on.
Well, let me give you an example. So the tax law is roughly 6,000 pages, right? A really small print. Right. And there's one line says all income's taxable unless we say it isn't. There's another line that says nothing's deductible unless we say it is. And there's a few charts and tables tells how much tax to pay. But 99.9% of the tax law is really a directive on how to reduce your taxes, how to pay less tax. That's really, and if you take that view that, look, I can, so my goal with tax-free wealth and my other book, The Win-Win Wealth Strategy, is to really give people a choice, right? You can choose to ignore taxes, pay high taxes. The government's fine with that. They're not going to complain about that. That's fine. Just pay your taxes, go your way. That's what you want to do. But if you have the information, you can actually choose to do something different. But without the information, you have no choice, and you're just stuck paying high taxes.
Yeah. Yeah. Now, we always hear about the wealthy don't pay their taxes. I keep hearing that. I think you have a different outlook on that. Can you kind of walk us through it, please?
Well, yeah, I would change that.
Yeah.
From the wealthy don't pay their taxes to the wealthy don't pay taxes.
Right.
So when somebody says the wealthy don't pay their taxes, you're basically saying the wealthy cheat. Yeah. And that is not my experience. Now, I'm not saying there aren't wealthy people who cheat. I'm sure there are.
Of course.
Okay. As a proportion, by the way, if you look at the IRS's own records, most of the cheating is done by middle class. It is not done by the wealthy. Proportionately, it's not done by the wealthy. And I think the reason for that is that the wealthy they have such good tax advisors. They don't need to cheat in order to pay less tax. They can just do the things the tax law allows. Whereas the average person, they don't understand the tax law. They don't have good advisors. And so their view is, well, the wealthy don't pay tax. Why am I paying tax? I'm just going to not report my income, or I'm going to take my boat as a deduction, or I'm going to take my dog as treat my dog like a kid, or, I'm going to employ my cat. I mean, they do really ridiculous things that are absolutely illegal. Yeah. And they do it just because they feel, I think, helpless. Right. And they don't see that there is another way to do it.
Yeah. I'm in a commercial brokerage company in Los Angeles. I'm a partner in it. And, we see a lot of entrepreneurs that are own businesses, mid-level. And I see, when we're looking at some of their numbers, I'm like, wait a second, you better be careful here. And so, but we look at some of our high net worth clients, we don't necessarily see that. So I agree. Yeah, it's more of the mid-level that we're starting to see it, but regarding real estate, commercial real estate mostly. Now, I understand you own some commercial real estate yourself.
I do. I own the building that houses my companies.
Okay. We just brought somebody on the other day, and this was a little surprising to me. And I think it's something that we should talk about is, people bought their buildings 3 and 4 years ago, top of the market. Now they're paying taxes on that. And, in Texas, I learned that we could appeal those. We appealed them every year. Here in Southern California, people don't appeal them. They don't think about appealing and getting that price lower. Now you're paying taxes on that lower amount. Could you kind of walk us through how that works and your thoughts?
Yeah. So that's not income tax. Obviously, that's property tax. And property taxes. So property taxes apply to anybody who owns property. Yeah. Commercial property, your own house. Yep. Property taxes are a big expense. And in some states, they're bigger than others. Like in Texas, probably the biggest tax people pay is property tax because they don't have an income tax, right? Mm-hmm. Yep. And so property taxes are actually a lot of money, particularly when you're talking about commercial buildings. Yep. I know how much mine are. And yeah. As a percentage, it's really high. It's way higher than my residential tax. Yeah. Per dollar, right? Per dollar of value. And so there's a couple of things that you can do from a property tax standpoint. I do actually talk about property tax in tax-free wealth. Mm-hmm. And first is look at comparisons to other buildings. And you can actually look online, look at your county, your county recorder, look at what they show online for other comparable buildings. You shouldn't be paying more than they're paying. So you might find that your valuation is unreasonably high compared to theirs. Mm-hmm. Or you might find that I'll give you a terrible personal example. It's a terrible story because I completely messed up. Years and years ago, I built a house in Tempe, Arizona. And I built a house with, it's a 1-story house with a basement. The main story was 2,300 square feet and the basement's 1,000. you're going, okay, so that's basically a 2,300 square foot house with a basement, right? Not for property tax purposes. In Arizona, if your second story is less than 50% of your main story, it's considered all one story. So when they valued my house for property tax purposes, it was a 3,300 square foot ranch house. Now, everybody knows very well that a 2,300 square foot house with a basement is not the same value as a 3,300 square foot house all on one level. And yet, because I had not actually looked at the property tax rules, it didn't even dawn on me to look at the property tax rules before I built my house. All I had to do was add a couple of hundred square feet to the basement, and it would have saved me a ton on property taxes. Probably wouldn't have cost me that much more in construction, and I would have had another 200 square feet, right? So, there's little nuances like that if you're aware of them. The cool thing in property tax is that it's pretty easy to find a consultant who will just charge you for a percentage of the savings. Well, that means it's kind of like a lawyer, right? That, takes a percentage of, if they win, they take a percentage. If they lose, they get nothing. The same thing is true with a lot of property tax consultants. So you have nothing to lose. And if they think that there's something there, I mean, what a good deal for you. You haven't spent any money, but you've reduced your taxes. And so what if they get 25 or 30%, you got 70% of something you wouldn't have had in the first place. So I think everybody, especially commercial property, should absolutely be looking at their property taxes and doing an evaluation every single year.
You'd be surprised how many people don't, though, Tom. It's shocking to me. I'm sure you
Well,
run into it.
I would not be surprised, because you would be shocked at how many people pay no attention to their income tax strategy, and pay high income taxes. I get them all day long. And the challenge I find is these people are coming from big accounting firms. And the big accounting firm did nothing for them. All they did was file their taxes, and they did no planning, because for the big firm, they were a small client. So, which is why I like the small firms. We actually have a franchise of small tax advisory firms. I like the small firms because you're going to get really good attention. And as long as they're well-trained, they're going to be just like a local restaurant. They're going to be just as good or better than the big guys, but you'll get a lot more attention from them. So very important to pay attention to planning, not just filing.
Yeah, I think, and I'm probably guilty of it too. When I was getting started off investing, it just really wasn't paying. I was so busy doing deals. It wasn't paying, attention to the details of the taxes, the income tax and the property tax. And I think there's a lot of hiccups there along the road. Actually, I know there is, because I went through them. But can you kind of walk us through, on the income tax side, what are the biggest mistakes that you're seeing, especially newer investors are making right now, or have been?
Well, the first thing they don't do is they don't account for taxes in their investing. I mean, that's the single biggest mistake people make, because they look at, okay, I'm going to compare my returns. I'm going to invest in this deal versus this deal. And they're looking at it before tax. Huge mistake. When it comes to real estate investing, I think the biggest mistake people make is to assume that if you're a passive investor, you can't use the losses against your business income, because that is false. That is absolutely false. A lot of people are aware that that real estate losses are passive losses if you're not an active, professional real estate investor. On the other hand, passive losses just mean you can only use them against passive income. So most people are so focused on, I can't use these losses against active income, that they don't look at the idea that, what if I could change my active income to passive income, and now I could use my losses. So that is a huge mistake. And I had a conversation with a partner in a big accounting firm, because they were handling the syndicator that some of my clients were investing with, and they weren't doing a cost segregation. And I'm going, why don't you do a cost segregation? They said, well, none of our investors get the benefit because they're all passive. I'm going, okay, so false, and shame on you, because you really do need to pay attention to the tax consequences when you invest.
Yeah. Can you kind of cost segregation? You'll see people's eyes cross, right? When you start, especially somebody newer. Cost segregation, they'll just kind of go, What is that? Can you kinda
It's
walk through
really
that?
it's really simple.
Mhm.
Just think of it this way. So you invest in a property, you're really buying four different things. You're buying the land,
Mhm.
you're buying the building,
Right.
you're buying the land improvements like the outdoor, the landscaping, the outdoor lighting, the fencing, the driveways, et cetera. And you're buying the contents of the building, right? The window coverings, the flooring, et cetera. Well, what the government has said is, well, look, we need to give you an allowance, okay, for the wear and tear on your property. Now,
Mhm.
the land itself doesn't wear out, so there's no allowance for that. The
Sure.
building wears out over a long period of time. The government has said that a commercial building wears out over 39 years. A little arbitrary, but okay, wears out over 39 years. A residential building, 27 and a half years, which I think that's probably a good proportion, since I do think that that individual renters are much harder on properties than commercial
Oh, yeah,
tenants.
definitely.
So, but then you look at the land improvements. Well, they're not going to last. They're not going to last 39 years.
Right.
So the government says, well, they're going to last 15 years. We estimate 15 years. And then the contents, we're going to estimate the last 5 to 7 years. Well, what you're saying is that if I had $10,000 and I allocated it to the building, versus allocating it to, say, the contents of the building, that means I'm going to get 2.5%, right? Roughly 1/40th
Mhm.
of the $10,000. I'm going to get 2.5% of that in a deduction. And so $250, right? That's all my deduction is going to be. Whereas if it's if it's the contents, I'm going to get 20% or more the very first year. So I'm going to get, instead, I'm going to get more like $2,000. I'm going to get like 10 times the deduction if I do this cost segregation. Well, why is that important? Because, well, you're a real estate guy. So you know that cash is everything
Oh, yeah.
in real estate. You've got to have the cash to do the deals. And so you want your cash now so that you can do the deal now. You don't want your cash 30 years down the road. You want your cash now. And if you can get the government to pay part of the investment, which
Yep.
is really all they're doing, you're paying part of the investment, they're paying part of the investment. And if you look at it that way, you go, wait a minute. Now, could I do it even better than that? Splitting it up. Now you have to hire an engineer, you have to go through it. But my experience is it's a huge tax benefit. It just accelerates the tax savings so much.
Mhm.
And now we have bonus depreciation. So 60% of those land improvements and the contents is going to be deductible the first year. So now you're not talking about like a $2,000. Now you're talking about like a $6,000 deduction on that $10,000 item instead of $250. So the numbers get really big really fast. And all it means is that you have to have another person on your team. Yeah, it's not like you have to do a whole lot of work here.
Sure.
And the tax benefits are always substantially greater than the cost of doing the cost segregation. And if you get, I mean, I've seen cost segregations that added an additional $1 to $2 million of deductions. I mean, why wouldn't you do that?
Exactly.
Because, by the way, you're not just talking about those different depreciation rates, but some things you can write off completely.
Right.
So 100%. And so you're really paying attention to the taxes when you're talking about investing in real estate. One of the most important things you can do. I would say it's actually the least understood and the most ignored, and it's done wrong all the time, even by very successful syndicators and developers. And I'm going, you just need better. You need to understand it better and get better tax advice.
Yeah. Yeah. It's now, what size building would you say is the minimum size that you would do on that? It's not for every building. You have to be,
I
1.5,
would
2
say
million.
like $200,000.
Oh, 200. That's far down.
Oh
Okay.
yeah. No,
Okay.
I mean, the numbers with the 60% bonus depreciation, the numbers are ridiculous.
Yeah.
They're just ridiculous. So any commercial building, 100% of commercial buildings should be have a cost segregation on them. And hey, one more thing. So here's a cool part, right? This is where I get a little nerdy on it. But let's say you bought the building 3 years ago.
Yeah.
You can do a cost segregation today and catch up your depreciation in this year.
Right.
So just because you didn't do it doesn't mean you can't fix it. And when you fix it, you're not doing anything wrong. In fact, you're actually changing to a method of accounting. And the IRS wants you to do a cost segregation. Now they're okay if you don't, because they'll take the money.
Sure.
But literally the tax law says, the tax law literally requires it. The IRS doesn't, but the tax law does. So
Right.
it's just one of those things that, boy, if you're not doing it, man, I think it's a mistake.
Yeah, it's a missed opportunity.
Yep.
For yourself and your investors. Now, there are some new regulations put in place in 2017 regarding bonus depreciation. Now, that's set to expire next year, correct?
2026. So
2026.
we're at 60%
Okay.
this year, 40% in 2025, 20% in 2026, and then it goes away. However, I will tell you, I believe that in 2025, because no matter what happens, most of the provisions of the 2017 Act expire in 2025. Because of that, there's going to be some major tax legislation, no matter who wins the House, the Senate, and the presidency. There is a lot of backing on both sides of the aisle for reinstating 100% bonus depreciation. So I would not be too surprised if that comes out of it.
It was bonus depreciation. Aren't we like at 60% now?
Yeah, we're at 60% right now.
60% right now. So they're talking about taking it back up to 100%?
Yeah. Yep. There was a bill, but the bill didn't pass because of the election, basically.
Oh. I'll get into the election at the end. I don't ever do political, but let's dive into it now. Since we started talking about it, what's the effects from the election here in November?
Oh, huge.
Yeah.
Huge tax. People are talking, they're talking about inflation, which by the way is another tax. It's just a regressive tax, mostly on poor people and middle income people. But the difference in the two positions is never been this wide. So the Democrats want to raise taxes by $5 trillion and the Republicans want to reduce taxes by $2 trillion. So there's a $7 trillion swing. And you go, well, I'd be okay raising taxes. We need to reduce the deficit. Well, that's not where the money goes.
Right.
The Democrats say that they'll reduce the deficit by $500 billion, which you and I both know is a drop in the bucket. Right. But that means they're going to raise spending by $4.5 trillion. Well, we know from recent experience that raising government spending tends to cause inflation. Right. And that's likely what will happen as a result. So it's going to put huge inflationary pressures, just like the COVID legislation, all that government spending caused the inflation in the first place, right?
Right.
And that's more of that. Whereas reducing it, what happens is then reducing taxes, you do have more money, right? So that could also cause inflation, which is interesting. It's not actually the raising taxes should reduce inflation, but it doesn't. And the reason it doesn't is because who you're taxing. If you are taxing the middle class, the people who are actually getting the money or spending the money, you would actually reduce inflation. It would put the brakes on inflation, but that's not the plan. The plan is to only increase taxes on people making more than $400,000, right? That's what the Democrats say. Yep. The Republicans, their reduction is somewhat across the board, but it does lean heavily towards more higher income people. It truly does. It does tend to benefit them. The interesting question there is, how does that affect everybody else? So remember that taxes, the term tax is really a drag on, right? You tax something, you're putting a drag on it. And you put a drag on the economy when you tax it. So if you're taxing the consumers, you're going to put a drag on the consumption, right? Which could actually hurt from a recessionary standpoint. But of course, if you put money back in, then kind of offsets, right? On the other hand, if you put a tax on investors In other words, you're putting the money, you're taxing the people who invest. You're going to put a drag on investment. And the difference is, it's kind of like, do I go on a diet for today, or do I go on a diet for the next 5 years? Because if you tax the investment, you're actually hurting yourself for a long period of time. Whereas if you tax the consumption, you're hurting yourself potentially for a short period of time. So it's really a question of time. And do you really want to put a drag on the long-term investing? Now, that's not to say there aren't some taxes that probably should be increased. Honestly, if you ask me, would I have an issue with, for example, Hillary Clinton's 4% surtax on incomes over $10 million? No, I wouldn't have a problem with that at all. That's not going to put a drag on investment. That's not going to change anything. But if you put, for example, they're looking at things like a capital gains tax of 40% if you're over $1 million. Well, that means every real estate deal is over $1 million, almost everyone, right? Yeah. Every business deal is over $1 million. And so what that means is that a business owner, a small business owner who they spend their whole life investing in their business, they sell their business, they're going to get hit with a 40% tax because that 1 year, they're over $1 million. Okay. To me, that's a huge issue. That's a huge issue. In your world, they're talking about eliminating the 1031 exchange. Well, if they did that, that would be a huge issue. That would take, I think, an enormous amount of liquidity out of the marketplace, right? And they're saying, well, it only applies to somebody who makes less than 400,000. Well, those people aren't doing 1031 exchanges. So that's really a meaningless provision to say it's not going to affect you. Now, I guess if you're doing single family homes and you're selling them, or a duplex or something, maybe. But even then, remember, if you're selling a property, you probably got a gain of 200,000-300,000, and now your taxes are over 400,000, or you're getting to that point. And it's not that I hate the Democrats' bill or love the Republicans' bill.
Right.
It's really more, I just think people should pay attention and not ignore. There's not been a lot of discussion in the media about the different tax recommendations and the consequences. There's been a lot of taxes. Let's tax the rich. Okay. Well, it's always easy to tax somebody else, right? The challenge is that taxing somebody else doesn't mean it doesn't hurt you. So if you look at, for example, the corporate tax rate, which was the single biggest revenue loser in the 2017 bill, over $1 trillion. Okay, what did that do? Well, look at the stock market. It had an positive impact on the stock market because the corporation's paying less tax, which means that your income's going to go up, which means your PE ratio changes, which means that the stock market goes up. Well, who owns the stock market? Well, a third of it is owned by the average person.
Yeah. It's
in pension plans, profit sharing plans, 401ks. So yes, it does benefit the wealthy disproportionately, but don't think it's not going to have an impact on the average person.
Right. Yeah. With these tax strategies, and they're changing all the time, how do we keep up on all the changes? Where do we go?
That's the challenge there's really nowhere to go other than good CPA. I mean, my wife's a CPA. We have very fascinating dinner discussions, bedtime discussions, right? Morning coffee discussions.
Fascinating all about to you, tax. Tom, or fascinating to everybody else?
Fascinating to us, right? Okay. Everybody else would be, what the world are you talking about?
I bet.
To us, it's just a game, and it's a puzzle, and we're kind of looking at these things, but they change all the time. I mean, just look at, we had several Supreme Court cases this last session that have major tax impacts. Okay. We had a decision on estate tax, on estate planning, with life insurance. We had Loberbright, which overturned the Chevron doctrine, which means that now all these regulations that IRS puts out, maybe they're not going to be allowed. Maybe the courts are going to overturn them. And then you had the case with the couple that invested in India. And is it going to open the door? Is that decision closing the door to a wealth tax or opening the door to a wealth tax? So there are, this is the type of stuff that nerdy people like me look at, but that's actually why, you actually need a good CPA who actually reads this stuff. Unfortunately, Joe, not very many CPAs read this stuff. I go to a national tax conference in Washington, D.C. every year. This year it's after the election. And what I find is most people are just learning the rules when they go to the conference. I'm going, I would like instead to learn how to use the rules because I've already read the rules. I don't need somebody to tell me the rules. I can read that. Okay. But having a good CPA, I absolutely believe best investment you'll ever make is in your CPA.
How do I find a good one? Do I just go to a mid-tier firm? Because I figure the big guys, like you were talking earlier, probably, my little account may not get a lot of
Mid-tier is even, I'm going to tell you, Joe,
yeah,
mid-tier is even worse.
is it
So
really?
if you're looking for really great food, where do you go? A chain or a local?
Local.
Local. That's what you do for a CPA too. Now, how do you find that good local firm? That's the challenge because they're not consistent, right? So chapter 23 of Tax-Free Wealth is how to find a good tax advisor. So start there. Okay. I can give you the easy button. I always love that commercial and the easy button. The easy button is to go to tfwadvisors.us, and this is our franchise. And you can look at the advisors, you look at who they are, what their experience is, what their specialties are, and you can actually choose an advisor that way. So, but I would recommend that if you are a serious investor or you're a business owner, do not be fooled by the mass marketing people and say that you just need anybody who calls themselves a tax advisor. You do need a CPA because you want a broader base of knowledge and a deeper base of understanding of your business.
Yeah. You have a lot of friends that just have a bookkeeper in house that works directly with the accountant. And
yep. That's
you need
awesome.
also a good bookkeeper though.
For sure.
Not a family member that's putting it together.
Thank you for saying that, Joe.
Yeah, I see that a lot.
I was actually teaching a course on tax and asset protection a few years ago. And I always tell people, I'm going, if your bookkeeper is a family member, your job tonight is to go home and fire them. And this guy looks at me and he's like trembling because his wife was his bookkeeper. And he actually came in the next morning and he said, Tom, he goes, you've changed my life. I told my wife what you said, and she goes, thank goodness. I hate doing it. So he was scared to death of firing his wife, and she was thrilled that she wasn't going to have to do it. But it's true, because if the bookkeeper, here's something to remember. The job of a bookkeeper is to create accurate records. Mm-hmm. That's the job of the bookkeeper. The job of the CPA is to analyze that information, not create the information, but analyze the information. If you don't have good records, though, if you don't have good books, you cannot make decisions. Your decisions are going to be really bad. And so you've got to have a really strong bookkeeper, and don't do it yourself because that's just a waste of your time.
Yeah, I mean, a good bookkeeper, especially if them and the accountant are talking and they understand what exactly the accountant's looking for, you're going to save a lot of money.
Oh, tons.
And you'll save more money.
For sure. And you'll save a lot of taxes because your CPA is going to be able to know, okay, I can trust these books and I can do my analysis based on this information that I know is correct.
Yeah. Tom, what are I got to get into some tax saving strategies. Is there a tax saving strategies that you've seen that's been implemented that you were really impressed with? Something that's really set you back?
Well, yeah. Well, we actually invent the tax saving strategies. That's actually what I do for a living. So I will tell you the most important aspect of this, and that is to take a very holistic approach to your tax saving strategy. It's easy to just look for the tricks and tips.
Right.
And by the way, if you want those, go to Tax-Free Wealth. I put the tricks and tips in there.
I'll put a link down below, Tom, and I'm going to put the book. It'll be a link on the website too, so everybody will be able to find it all.
Yeah, and it's the third edition. It's been updated for all the recent legislation, so it's absolutely the newest and the best and the brightest. It's actually the best version. It's the third edition. It's the best one we've done. But I think there are three questions that your tax advisor ought to be asking you. And you can ask yourself. The first is, how do you make your money? Because how you make your money has a big impact on how much tax you pay.
Yeah.
If you make it as a real estate investor, you're going to pay a different tax than if you make it as an employee, right? Or a business owner. So that's actually question number one. Now, there are a lot of tax advisors who will ask that question, but they will stop there. And I think that's where people lose out. And this is where a top-notch tax advisor will differ, because the second question is more important than the first. And the second question is, what are you going to do with your money? What are you going to do with it? Are you going to spend it? Are you going to invest in real estate, energy? You invest in the stock market? You're going to save it for retirement? You're going to give it away? What are you going to do with your money? That has a bigger tax impact than how you make your money. And then the third question, which I never hear anybody I hear myself ask it all the time, but I've literally never heard anybody else ask it, is what are you going to do with your money when you die? Right. Because you can actually, if you can look that much forward, then you go, okay, I could actually get a tax deduction now and when I die if I plan accordingly. And one of the things people should be doing between now and the end of the year is doing their estate planning, because we're going to have very likely changes to the estate tax laws next year. And if you have any kind of net worth, you ought to be looking at doing your estate planning. But there are a couple of tricks and tips I'm happy to share, because I don't mind the tricks and tips as well. The first is understand that your choice of entity, how you own your assets, is probably 50% of the game when it comes to what do you do with your money. So if you're a business owner, you probably want to be an S Corp or a C Corp. If you're a real estate investor, you probably want to be an LLC taxed as a partnership. Some of it depends on your state too, because different states. So like Tennessee, for example, has a 6% tax if you're an LLC, but no tax if you're a sole proprietor. So you can't ignore the state taxes either. And then a couple of other simple ones. People may have heard of the Augusta rule. This means that if you rent out your personal residence for 14 days or less, you don't pay tax on the income. Well, let me give you a cool example. So Rihanna at the Super Bowl last year was in my backyard in Phoenix. And she rented out a house in Paradise Valley, which is up the street from me. And she paid $800,000 for 10 days, $80,000 a night for this house. That $800,000 to that, if they did their homework and did it right, that $800,000 was tax-free, because it was 14 days or less, your personal residence, no tax on that $800,000. So that's actually a pretty cool strategy. I will tell you one that I've actually talked about as I've traveled the world with Robert Kiyosaki, and it applies in every country, it appears, and that is employing your kids in your business. And you go, well, how does that help? Well, your child has a standard deduction, $1,000. Well, that means that the first $13,000 you pay them is not taxed, but if your business pays, you're going to get a deduction and they're not going to pick up income. And then what if you put that money, had them invest that either through a Roth IRA or invest it in real estate? How much better saving for college is that than a 529 plan? I mean, so much better, because you get an immediate tax benefit. You get to control the money. And if you do it right, you'll never have to pay tax on it. So, those are a couple of big ones. I'll leave you with the one that I think people miss the most, and that is the home office deduction, because their accountant says it's just not worth it. But here's where it's worth it. Yeah, the deductions for the home office are not huge, but if you have a home office, your deduction for your car is probably going to be double than if you don't have a home office, because the IRS says that the first trip of the day is a commute and non-deductible, and the last trip of the day is a commute, non-deductible. Well, for most of us, that's 50% of our driving is the first trip and the last trip. If you have a home office, your commute's from your kitchen to your home office. It literally, and the IRS says that right on their website. Okay. So there's an enormous deduction. I mean, your car expenses could be $10,000 a year. You have 10,000, you might have $5,000 additional deduction that you're missing from a car deduction just because you don't have a home office.
Well, that's one I bet a lot of people miss. Tom, let me ask you something. A property with higher operating expenses, like multifamily, would that be a better opportunity for savings compared to a single tenant net lease deal? I would think so, right? Because the operating expenses you can.
Well, so remember, cash is always better than tax savings.
True.
So,
Yep.
so never let the tax tail wag the dog. Okay.
Yeah.
What does it, is it better from a tax standpoint? But yeah, but so is not making money.
Yeah.
So I always look at the investment after tax.
Yeah.
What's the consequence of investing? And not just how much tax are you paying on the investment, but does by investing in that property, how much money does it save you? So for example, let's take your triple net lease that you're talking about in a commercial office building. You're still going to do a cost segregation, right? You're still going to get all the bonus depreciation. You're going to get all that, but that's not an out-of-pocket cost. In fact, the bank's probably paying most of that. And so you're going to get this huge tax benefit. And yet it's a triple net lease. So what it means is that you're effectively getting a deduction for the expenses that they're paying because you're not picking up the income in the first place. So right. I think it ends up about the same spot, except that you don't have to worry. You don't have to worry about all the expenses and all the risk of the expenses because it's a triple net lease. I actually love triple net leases. There is one weird tax issue, and that is that it's going to be a passive loss for you. So you do have to take the other approach and say, wait a minute, I need passive income. If you have a triple net lease, you're probably not going to be able to take that except against passive income. So that's where kind of comprehensive tax planning is so important, because I can't tell you how many people have told me that they couldn't take their losses because they were passive. And I'm going, well, have you thought about turning your income into passive income? No, nobody's ever suggested that. Well, it takes a little more work, but it can be worth thousands and thousands of dollars.
Yeah. If you had $1 million to invest right now, Tom, what asset class would you be investing in?
I would invest in the asset class that you've decided is your asset class.
You should get into politics, Tom.
No, I'm dead serious about this. So
yeah, no, I feel you.
So I'm a big fan of a niche will make you rich, and diversification is for losers. Okay. Right. Diversification works great if you're trying to protect your assets. It does not work very well for building your assets. Okay. That's where you want a niche. Well, I don't think any asset class is better than any other asset class. It's just better for one investor versus another. Warren Buffett, one of the richest people in the world, his asset class is business. Okay. Where you have yourself and others where their asset class is real estate, and yours is specifically commercial real estate versus residential real estate. Well, I would tell you that the best place for you to put $1 million is into real estate. Because that's what you know, and that's what you're good at. For me, my best place to put $1 million is going to be business, because that is my asset class, is business. And so while I understand real estate, I certainly understand the tax consequences. I understand oil and gas. I understand all the energy. I've invested in all of these different things. I actually had my Series 7 license at one point in my life. So I've got some experience in the stock market. What I love is business. So I think your asset class ought to be something you love doing, because you'll get better at it. You'll spend more time at it, and you'll be more successful at it.
I couldn't agree more. If you could, and this is one thing, you mentioned Nashville, and it made me think of a question. Is if you had a state to choose from to invest in real estate right now, a lot of people said, I don't want to be in a Democratic state. They say, I'm going to Florida. I go, okay, well, there's no state income tax, but there is a higher corporate tax. Are you aware of that? People make these knee-jerk reactions. Or decisions, and most people didn't even realize that before they just were emotional about it. What state would you be looking at to invest right now?
Well, I'm more likely to look at those states I would not be looking at. and they tend to be on the coasts.
Yeah. Yeah.
And you live in one of them.
Yeah.
And the reason I wouldn't is because it's not just the tax consequences, but it's actually, I'm looking more at, are they friendly to a landlord? If I'm going to invest in real estate, I'm going to be the landlord. So
Yeah.
I want to be in a state that's friendly to landlord. I don't want to be in a state that is, so like Tennessee, for example. I don't know otherwise how they are with tenants and landlords, but I know that if you try to protect your assets through an LLC, you're going to pay that 6% tax.
Yep.
So that is saying, we're pretty pro-consumer. Yeah, I think you have to look at all the different criteria from a tax standpoint. Your low tax states, whether it's Texas, Arizona, very low tax state now. Florida, as long as you're not a corporation, low tax state. But you also have to look at property taxes. I mean, Texas is very high property tax state. So you really do. And I'm not trying to waffle on this. I'm just saying that I think, I go one step further than that niche. I'm going, every successful investor I've known, professional investor, has a very specific set of criteria for investing, and it includes their market. So for example, I mean, the question could be, well, am I better off investing in Class B property or Class A property? Well, I don't know. It depends on what's your niche.
Mm-hmm.
I've had clients. I have a lot of clients who are developers, and I have clients that have been successful Class A developers. They build brand new stuff and it's beautiful and they do great. And then I have others that build Class B property. I have other that buy Class B property and improve it, or Class C property and bring it up to Class B. I have a client who takes Class B property, brings it to an A minus.
Yeah.
And that it's that improvement in the value that I think is important, but it's really finding where's your tenant base, right? What kind of tenant do you want? What kind of property do you want? How big of a property do you want? What's going on in the surrounding area? I personally love opportunity zones, just because from an investment standpoint, because they're on the edge, right? They are more likely to have an increase in value than one that's right in the heart of the city, right? They're just more likely to have an increase in value. So I always personally, I'm always looking for, how do I improve the value? What can I do to increase the value of my investment? Not just what does the market going to do to increase the value of my investment? Because I'm a entrepreneur and I like as much control as I can get.
If there's anything I learned from, sitting here listening to you and in your videos over the last week, which everybody, you should check out Tom's, he's got a ton of videos on YouTube, and I learned a lot from you this week and I'm very appreciative of that. But what I really learned is a newer investor is really need to do due diligence on all the tax codes, understand this before they even start looking at a property, know the area. And, I think it can make you a lot more money.
Well, and as I like to say, if you want to change your tax, you have to change your facts.
Yeah.
And I can't change your facts for you. I can tell you which facts to change, and you have to do it. So there is work that you have to do. So read Tax-Free Wealth, read Win-Win Wealth Strategy, get that education, listen to my podcast, The Wealthability Show, and get a good tax advisor.
Yeah.
But you have to do the work. If you're going to change your tax, you do have to change your facts.
Yeah. I think there's a lot of re-education going on in real estate investing right now, Tom. It's been fairly easy the last few years. And now we're getting back to what it takes to really be a solid investor. And, the people who are doing this all along are going to be fine. People that were riding the wave, it's going to be a process for them. What's next for you, Tom?
Well, so we're building out the franchise all over the U.S. We have 10 firms right now. We just launched, and we're building this out. We want to be able to serve a broader group of people. We want to make sure that if you're a new investor, you get a CPA who specializes in new investors, so that you're one of the most important people. You're just as important as any other client they've got. If you're a high net worth investor, you're with a firm that handles high net worth investors. And so that's really what we're doing. And then we're constantly looking at how do we provide better education to more people because the better educated we are, the less risk we have, the less taxes we pay, the higher the rate of return, and the more control we have over our life.
And the more wealth you're going to build.
And the more wealth you will build. That's correct. It's a fact.
On that, Tom, thank you very much. I'm going to put the books on the website. If anybody has any questions for Tom, just put in the comments. I'll make sure he sees them. And, thank you very much, Tom.
Awesome. Anytime. Happy to be here with you, Joe.
Well, we'll probably do this again soon. And for those of you watching, thank you for taking the time. If you could, please give us a like. If you haven't done so, make sure you subscribe.